Hello, and welcome to the Duke Energy 2013 Federal Tax Return Reportable Transactions presentation. The purpose of this video is to educate key people at Duke Energy about reportable transactions to enable them to identify any 2013 transactions entered into by Duke Energy that require a review by the Duke Energy Tax Department to determine whether any disclosure should be made in our 2013 federal income tax return for any transactions that could be classified as reportable or listed transactions. In viewing this video, we ask you to keep in mind that we are asking you to consider and inform us if there are any transactions that occurred in 2013 that you are aware of that may be the same or similar to those described in this video or in the materials. So what is a reportable transaction? Simply put, reportable transactions are those transactions that the IRS views as having the potential for improper tax avoidance. It's important to note that we are not asking you to make a determination whether a transaction is improper or needs to be disclosed under tax rules. Instead, we are seeking your help in identifying any 2013 transactions that should be reviewed by tax department to ensure we properly report transactions of our tax federal and state income tax returns. There are 6 categories of transactions the IRS and states required special disclosure on. Confidential transactions, transactions involving contractual protection, loss transactions, listed transactions, transactions of interest, state-specific listed transactions. This video covers the first 3 categories, while the last 3 categories of transactions are described in the memo attached to the email you received. The disclosure of reportable transactions is important because of the potential for monetary penalties to be imposed for failure to make disclosures of reportable transactions as required in Treasury regulations and IRS guidance. Failure to disclose penalty, as listed. An accuracy penalty, and SEC rule. Participation in a reportable transactions creates the tax requirements that the taxpayer attach disclosure statements to their federal and some state income tax return describing those transactions and providing additional details of the transaction. We have a disclosure statement and participation. The first category of reportable transactions is confidential transactions. These are transactions in which an outside advisor enters into an engagement agreement with a taxpayer to promote or sell an investment or a transaction strategy in which the advisor receives a fee of $250,000 or more, and the engagement agreement contains a condition of confidentiality provision. That confidentiality provision prevents us from disclosing the tax treatment or structure of the transaction to third parties and is aimed at preventing or limiting disclosure of the advisor's tax strategy. These types of provisions were common in engagement agreements certain transaction strategy promoters marketed prior to 2001, but are rarely, if ever, found in consultant engagement agreements today. It's important to note that this category of confidential transactions is not intended to apply to confidentiality provisions in agreements that we enter into with another company or participant in a transaction in which no outside advisor places a confidentiality limitation on our ability to disclose the transaction or tax strategy relating to the transaction. For example, this transaction does not apply to purchase or sale, merger or spin-off agreements we enter into with other companies. Contractual protection. The second reportable transaction category involves certain transactions involving agreements with contractual protection provisions. Like the confidentiality provisions, these provisions may be found in consultant engagement agreements or those of outside advisors promoting a transaction strategy to Duke Energy or one of our affiliates. The contractual protection category involves consultant or promoter engagement agreement provisions that provide either 1. That the taxpayer has a right to receive a full or partial refund of fees if all or part of the intended tax consequences from the transaction are not ultimately upheld or realized, or 2. Fees paid to the consultant or advisor are contingent on the taxpayer's realization of tax benefits from the transaction. The explanation of the exceptions to contractual protection provisions indicate that they are only prohibited in the area of income tax benefits and do not apply to engagement or advisor agreements involving non-income taxes. Examples include sales and use taxes or property taxes. In addition, the prohibition on contractual protection provisions does not apply to engagement agreements that contain certain termination rights or that relate to previously reported transactions or employment-related tax credits. The third reportable transaction category is loss transactions. Loss transactions cover any transaction that results in the taxpayer claiming a loss deduction on their tax return of $10 million or more in any single tax year, or $20 million in any combination of 6 consecutive tax years. Generally, a reportable loss may result in either a sale or exchange of an asset or investment, or a disposal of the asset or investment. So we have a cumulative loss, and also here is some additional information. A loss from a sale, exchange, or disposal of an asset is not a reportable loss transaction to the extent that our basis to the asset or qualifying basis, which means that our basis in the asset or investment is based on cash paid for the asset or investment, or our basis in the asset or investment is based on the tax basis that has been carried over from a non-recognition transaction, such as a tax-free spinoff or a tax-free reorganization or like-kind exchange. So what is the bottom line? If a transaction is too good to be true, it probably requires a review by the tax department. Please consider whether you are aware of any transactions that fall within the categories we have described and fill out the statement attached to the email. This statement asks for your name, job title, signature, and date, and whether you're aware of any transaction that occurred in 2013 that you think may be the same or similar to any of the 3 categories of reportable transactions that we just talked about. That is, a transaction that involved an outside advisor who had an agreement that contained a confidentiality provision or contractual protection provision, or a transaction that involved a loss of $10 million or more in 2013, or $20 million or more over 6 years. The second part of this video covers listed transactions. Listed transactions involve transactions that are the same or similar to the 34 transactions that are described in the summary memo. In contrast to the first 3 categories of reportable transactions, listed transactions are specific transactions that the IRS has concluded involve improper tax avoidance. As a result, these are transactions that the IRS has stated that any taxpayer entering into transactions that are the same or similar to the 34 transactions described in the memo will be challenged as to the right to claim any tax benefits associated with the transaction. Instead of discussing each of the 34 transactions, we ask you that you review the memo as part of this process. In the 1-page listed transaction summary included with your materials, we have grouped the 34 transactions covered in the memo into 7 categories, the first 5 of which list involve listed transactions. Income and deduction shifting among different parties. In the first box of category, we have grouped those transactions that involve the improper shifting of income and deductions among tax-indifferent parties. Tax-indifferent parties are taxpayers that are not subject to U.S. tax, either because they are tax-exempt entities or because they are foreign taxpayers. If you look at that first category, you will see that we have identified 6 transactions as falling into that type of listed transaction. Loss deduction and credit acceleration transactions. To the right of the first box, in the second box, which are transactions that involve claims of tax losses or deduction and tax acceleration transactions. These transactions involve what the IRS has determined to be the improper acceleration of the timing for which a taxpayer may claim losses, deductions, or tax credits. We have put 10 of the 34 transactions into this grouping. Transactions involving tax shelters and transactions lacking economic substance. The third box indicates transactions that involve improper or abusive tax shelter transactions and transactions that lack economic substance. These are transactions that the IRS considers to involve or apply tax rules in a manner that is abusive and not as the rules were intended to be applied, or transactions that have no real opportunity for economic profit other than the realization of tax benefits. As you can see, we have listed 3 listed transactions that we have grouped into this classification. Transactions involving qualified and non-qualified benefits. This group of transactions involves qualified and non-qualified benefits such as contributions to 401k plans, pension plans, and strategies intended to avoid contribution or other limited related to benefits provided under the Internal Revenue Code. We have grouped 7 transactions as involving benefit-listed transactions. Transactions not relevant to Duke Energy. Transactions we have put into this grouping involve transactions we do not believe that Duke Energy or its affiliates could be involved in because they involve transactions involving trusts, subchapter S corporations, or estate planning transactions. We have grouped 7 of the 34 listed transactions into this classification. Transactions of interest. While the first 5 categories of transactions to which we have classified the 34 listed transactions are those the IRS views to be abusive and those that the IRS will challenge, transactions of interest are different. These are transactions the IRS is still evaluating in order to make a determination of whether they believe the transactions involve improper tax avoidance or involve permitted types of tax planning. While taxpayers are required to disclose if they enter into a transaction that is the same or similar to a transaction of interest, the IRS has not yet made a determination of whether they will challenge a taxpayer's claim of tax benefits associated with one of these transactions. As reflected in the chart, the IRS has identified 4 transactions of interest. State-specific listed transactions. The final category of state-specific listed transactions involve transactions that states have identified as listed transactions that must be disclosed in their state income tax return. At this point, we'd ask you to review and sign the statement on the last page of the memo indicating whether you are aware of any transactions a Duke Energy company entered into in 2013 that may be the same or similar to any listed transactions of interest, or state-specific listed transactions. If you are not aware of any transactions that Duke Energy Company entered into in 2013 that you think may be viewed as improper or of questionable validity that we should review, please write none in the bottom portion of the statement. If you are aware of any transaction that you think we should review or consider whether they should be disclosed or whether it follows established tax rules, then we ask you to give us a brief description of the transaction, and we will follow up with you to clarify the transaction you are referring to if we have any questions of what transactions you have identified. Thank you for your time and attention. If you have any questions or concerns, please contact Marcus Shore, Director of Federal Tax, at 704-382-1045. Again, thank you.